18, and thanks for joining us. Let me ask you to tell us the big questions you are being asked, Rajiv, by clients, investors about India, because we've had a period of relative underperformance. But as James Sullivan and others have been pointing out, it was, of course, the last 1 year has been followed by a couple of years of sharp outperformance. So is it just that, or it's a mix of things? What's top of mind, Rajiv?
Good morning, Prashant, Rima and Nigel. And first of all, happy Navratri to you and your viewers. Overall, a good start of the festive season with all hopes and prayers from my side too. The questions which commonly being asked, number one, question is when we expect a thaw happening in US and India relationship. That's the number one question to me and my management right across over here. The second one is when we can expect the double-digit growth handle, because now 4 to 5 quarters have gone. India is still trading at close to 5 to 6 peg ratio, and market wants them to come at a 2 peg ratio per se. So the double-digit growth is the second one. And last but not the least, when do we expect foreign investors to come back to India after last 4 years of exodus? Because it's not just a 1 year story. If you look at cumulative flows for the last 4 years, FIs are missing in India. So that's what we are trying to address and trying to show them on ground that what is happening in India and why you should revisit the thesis. And especially where India is seeing the worst ever underperformance since 1990 of close to 25 to 30% in a scenario where EM assets or Asian assets are making a comeback under the big diversification theme because of the dollar weakness, because people want to move away from US denominated asset class. In that scenario, India is still not making a comeback. So this is the kind of a questions we are all trying to address through ourselves and making them meet even experts also on here.
So Rajiv, how are you addressing the question on when FIs will make a comeback into the Indian markets? What is your own sense, speaking to so many experts and investors since yesterday?
So Rima, it's all interlinked. So number one most important perspective FI want to see is how the relationship continue between India and US. Remember, India and US have been doing businesses, investment all across for 25 good years between each other, and US have emerged as one of the biggest partner for India, and we have seen the pleasantries which was being exchanged between President Trump and Prime Minister Modi during his 75th birthday over there. So investors want to see now this to be taken one step further, maybe by reducing tariff by 25%, the additional penalty that was imposed on India 1.5 to 2 months back. So thawing of relationship is the catalyst number one, which can lead the risk premia in India to get lower, and India's P re-rating can happen in line. Again, this is a contrarian view I'm giving you, a P re-rating for India, what other emerging market have enjoyed year to date or for the last 1 year, and India has not enjoyed at all. That's number one. Number two, the earnings momentum or revival of earnings. Remember, as I've said earlier, 5 quarters have gone. India's trailing 12-month earning growth is in handle of around 4.5, 5, and trading at a PE of around 22. Investor want double-digit handle to come. That justifies India peg ratio close to near what S&P 500 is trading, 2.1, 2.2x kind of a stuff. And that's where India makes a comeback. And lastly, continuing the good work, which we have seen in form of 3 arrows. Arrow number 1, monetary policy easing. Arrow number 2, in form of tax rate cuts during the budget. And arrow number 3, the GST cut. Now the market want to hear the 4th arrow, that is the next generation reform in form of deregulation and easing my FPI and FDI entry into India markets. So these are the 3 set of measures what markets want to hear.
Okay, all right, Rajiv, good to see you again and hope you're having a good conference. Let's focus on the third point that you mentioned. GST 2.0, that's clearly got a few sectors very, very excited. Case in point being autos. And you all as well have done a bit of a pivot. Do you think that sector is set for better times? It's already had a bit of a run. I think earlier you all were neutral on that sector. But how do you expect this sector to pan out from here on?
We think it's a start. It will lead to an improvement. it's very easy for people to anticipate when the GST cut is happening, it will be just benefiting staple. In reality, when you start saving more, you will go behind your aspiration and more of your discretionary consumption, which you have been postponing because of lesser amount of a saving you have in the past. Taking that into account, step one, I never anticipate people will start going straight into the real estate sector, buying houses. But the easier one is more four-wheelers, more two-wheelers, and even some jewelry stuff also for their near-dear ones overall. So discretionary items are the one who will be the beneficiary. And I don't think it is just a 1 quarter, 2 quarter story, because GST cut is not one-off. It is here to stay. And like we have started with the GST cut, maybe in 12 to 18 months, on the same show, we will start talking about even the 8th pay commission, which also will be a bigger driver for consumption, or you can say further accelerator for consumption after the kind of a 3 arrows which we have seen so far.
So better times ahead then for the auto pack.
100%. It's consumption over capex, and that's what we are going to see for the next coming 4 to 5 years in India.
Okay, all right. You know, the uncertainty continues on the tech pack though. A bullish argument would be that they have not done much, they have underperformed. Maybe the bad news is in the price. When you get sound bites coming in from the United States like we saw over the weekend, maybe it's not a very material impact. Most sell-side notes had written that. However, the index itself was down 3% yesterday, telling you the kind of nervousness on this sector. Do you think there's still more pain, no big growth, headwinds coming in from the United States, and deal closures taking longer than anticipated as well? So you'd rather stay away?
No, we are more in a transition kind of a phase at this juncture, because market is trying to figure it out where we are heading in this kind of a geopolitical uncertainty, what kind of a world we are in, whether it will be a unipolar, whether it will be a bipolar, or whether it will be a multipolar kind of a world over there. And definitely then my exporters are at a stake in this kind of a world which we are going enter into. Taking that into account, it's unfair then to give a lower risk premium to such sort of a places, and the better way to trade this space is through earning growth. Now, growth is a key problem in IT sector from the last 12-month perspective or last 24 and 36-month perspective. They kept on delivering bottom line for you by cutting down people, by firing staff over there, and still delivering growth for you. But right now we are at a cusp where your IT sector growth has come down less than 5% on a 12-month trailing basis. We saw the similar things happening in the FMCG sector also for close to 10 years. And unless the revival applies, people never gave FMCG sector 60, 70p. They were bringing it down to from 60 to 50 to 40 to 35. I believe in IT we are heading in same phase unless IT gets back 10% plus kind of an earning growth from a future lens perspective.
And that, for now at least, looks a bit unlikely for this year and next. Rajiv, just the bigger picture about emerging markets. Now, you believe it's the coming of Goldilocks market when it comes to Asia ex-Japan. Can you explain your thesis? And it's had such a good run. I mean, this is the best performance we've seen since the dip in April. Is there a risk that the positive catalysts are now, we're running out of positive catalysts?
Not yet. I think this is just a start. Just to share some number with you, a 1% dollar depreciation leads to 4.5% increase in EM equity performance based on the historic sensitivity basis. This year, dollar has gone down 12%. If you take that sensitivity into account, you need to be easily up 50 to 54%. EM is up close to around 28%. Asia is up around 26% only, which means there is still performance based on the historic standard pending. Now, going into the next year, JPMorgan is forecasting end of this year DXY at 95, and by June next year 92, which means further 5% depreciation. And again, you multiply same sensitivity, another 25% return. If dollar is on the downward slide, diversification is going to remain a criteria. And not only equities, across asset classes in Asia, in emerging market, we are going to see benefit. Look at this year, Asia ex-Japan index is up 26%. Fixed income in Asia has given 7% return. Cash has delivered 3% return. And most of the currencies have driven 5% return. Next year, when we are going to see a synchronized global easing, where my US is increasing its fiscal deficit, Europe is also doing the same, and China, to revive their growth, provide you 40 to 50 basis point of fiscal thrust, along with 80% of global central bank easing. What does it mean? It means we are entering into synchronized easing cycle, which has happened in past during either GFC or during COVID. And after that, we all know what happens to risky asset classes and market. So we are entering that environment over the next 12-month period, which means we are just at the start over here. And if you take my positioning into account, global investors are 800 basis points underweight on emerging market. This year, they have not participated in EM equities fully and they have missed the rally. Korea, China, Taiwan, all rally has come on the back of domestic money per se, which means my FIIs will be the chaser into this rally as you go into the next year.
So how much more upside for emerging markets? I mean, in percentage terms?
So we are working for our 2026 outlook targets for EM overall. We have just surpassed our bull case on emerging market of 1350. The 12-month forward Asia ex-Japan index target is 1,000 points from here on. And we are saying it will trade at 16.6 PE, which is still below 2007 territory and 2021 territory. But the kind of a liquidity train which is going to hit us, I'll not be surprised the regional indexes going to trade at even at 20 PE also.
Rajiv, on that point about synchronized rate cuts, right? Global synchronized kind of easing. The call is that economies stay strong, but you get rate cuts. So best of both worlds in that sense. That's the call. I mean, you don't see significant weakening because then, in response to that, if you get a cut, that's not exactly great. But you're saying that economies will remain strong to so-so, but you get rate cuts.
Prashant, that's what's been happening since April. In April, US have made 4 pivots for us. Pivot number 1, they talked about fiscal austerity and they have given us OBBA. They set the low. Second, they set the lower bar for Fed also to cut, and now we have seen Fed has started cutting. We are calling for 75 basis points more rate cut from here till March by the Fed. Third, we all worried about the AI diffusion law not supplying the high-end tech to the US over there, but they have eased the chip exports and everything to the rest of the world. And last but not the least, we worried too much about the tariff at the start of the year. But what happened finally? Deals are happening, tariffs are much more measured over there, and exports are still growing. So taking that into account, where my economy is still growing higher, and consensus economists are literally eating back their word and revising growth higher. Remember, consensus was forecasting recession in the second half of this year, and now all the forecasts in the US are for around 2.5 GDP growth in the third quarter, 2% GDP growth in fourth quarter. And mind it, for the next year also, growth number is 1.9, which means they want to run economy hotter going into the next year.
Yeah, no, absolutely. Great conversation, Rajiv. Thank you very much for joining us, and hope you come on more often. Good sort of 360-degree perspective.
Thank you.
With you, as always. Well, I think I want to play out one important soundbite here now. So, India's chief economic advisor, Anantha Nageswaran, has said that he expects GDP growth to be near 7% this year after the GST cut. Speaking with CNBC-TV18's Shireen Bhan on the sidelines of Network 18 Reforms Reloaded Summit,